Gary Shilling is an economic consultant and investment advisor, as well as a longtime columnist for Forbes magazine. He is president of A. Gary Shilling and Company, Inc., and publishes A. Gary Shilling's Insight, a monthly report of economic forecasts and investment strategy. Dr. Shilling is a member of the Nihon Keizai Shimbun Board of Economists, a columnist for the Christian Science Monitor, and on Investment Advisor magazine's panel of investment strategists. He appears frequently on business shows on radio and television. Dr. Shilling graduated from Amherst College, A.B. in physics, magna cum laude, Phi Beta Kappa, and earned an MA and PhD in economics at Stanford University. Please give a warm welcome to Gary Shilling. He's also a brilliant money manager.
I was going to do that for you.
Are you going to?
Yeah.
Thank
you. Well, thank you, Kim. It is a great pleasure to be here. We are in Caesar's Palace here, and we're all trying to communicate, and that reminds me of a story that took place not in Caesar's Palace today, but in ancient Rome. It seems this Christian had been tossed into the lion's den, and he knew he was in trouble when the gates opened and one huge male lion started bounding out and making smaller and smaller concentric circles around this Christian. Well, he figured the end was near, so he did the only logical thing. He drops to his knees, folds his hands as saying his last prayer. Well, after a couple of more laps, the lion comes to a screeching halt in front of the Christian, drops to his knees, and folds his paws. Well, the Christian looks up at this huge lion. He says to him, "Ha-ha, at last we're communicating." And the lion looks down and he says, "I don't know about you, bud, I'm just saying grace." Well, as Kim mentioned, I'm an economist, and please don't hold that against me. Our approach is very much top-down. We start with the economic, the political, the financial spheres. We develop a forecast from there and then see what investment strategies logically follow. And we apply this in three areas. We act as economic consultants to major financial institutions. We also publish a newsletter, Insight, and we eat our own cooking. We manage some money so that when I talk about securities one way or the other, you know that that's where we are, and we are involved in that with our clients' money, with my personal money, with my family money, foundation money, a lot of other aspects of this. In any event, in early 1980, I talked about the unwinding of inflation. Now, at that point, inflation was in double digits, and very few people thought that that was possible. And I wrote a book on that, and it recommended stocks and bonds, which were very much under-owned because everybody won't own tangibles, antiques, artwork, things that benefited from inflation and not things that would benefit from an unwinding of inflation. In 1998, I wrote the fifth of 8 books I've written called Deflation, Why It's Coming, Whether It's Good or Bad, and How It Will Affect Your Investments, Business, and Personal Affairs. This book was obviously not very popular at the time because very few people thought that deflation was possible. Yes, we'd had some unwinding of inflation, but going all the way to actual declining prices on a chronic and widespread basis, very few people saw that as possible. Interestingly enough, recently Tom Keene, who some of you may be aware of, he's a senior anchor on Bloomberg TV and radio, he said, and I quote, "Here is the primer from The Economist with a single best call of the past 20 years. This is the primer to make you aware of deflation." Well, that is really what I'm concentrating in my remarks today. And some of you may have read that book, and some of you may have read a more recent book, and I think Kim's got a copy of it here, called The Age of Deleveraging, Investment Strategies for a Decade of Slow Growth and Deflation. Thank you. You did that exactly as rehearsed. Thank you, Kim. I appreciate that. In any event, this really updated this, but let me, in a very short period of time, since we are running late here, condense what I have been saying all along about this. Now, I think we are in what I call the age of deleveraging. We're working off the excess debt that was built up globally in the 1980s and 90s. And with that, when debt was increasing, spending was growing faster than incomes. In other words, people were incurring debt to bridge the gap between their incomes and their spending. And that added about a percentage point to GDP growth. Now we're in the opposite side of the spectrum. We're now looking at saving rates going up. I'll come back to that with some slides in a minute. But it really is slowing growth. And in this book I wrote in 2010, The Age of Deleveraging, I forecast that GDP growth, while this deleveraging was going on, was going to run about 2% in inflation-adjusted terms. Well, so far, since this recovery started in the middle of 2009, it has averaged 2.1%, almost exactly on my forecast. And the U.S. is not alone. We're seeing slow growth throughout the world. Europe is slower than the U.S., and Japan even slower than that. Now, normally it takes about 10 years to work off excess debt after a major borrowing binge. It'll probably take longer this time at the rate we're going. But the point is that this whole situation is with us. And another very important factor here that has been going on the last 20 years is globalization. I'll talk a little bit more about that later in terms of China, but globalization has basically been the shifting of manufacturing, other production, but mainly manufacturing, to developing countries, China, of course, first and foremost. And that has really changed the whole scope of things. It's really created some very interesting situations. I mean, we talk about right now about income polarization. And we look at many people who are being left behind. Well, there's always people left behind in the process of industrialization. That started off in England, in New England, in the late 1700s. As a matter of fact, I was mentioning to George Gilder earlier today the word saboteur. Anybody know the origin of the word saboteur? Anybody here? Well, it comes from, I can't see, the lights are on me, I'm sorry. But it comes from the French word sabot, which is wooden shoes. And what happened was that early in the Industrial Revolution, the workers who saw themselves being displaced and the power looms getting rid of the hand weavers, they ground their wooden shoes that they ground them into the machines to wreck the machines, the sabots, and that was the origin of the word saboteur. That's been going on, but industrialization has created more jobs than it's destroyed. But with the movement of all these jobs because of manufacturing moving from Europe and North America to China and elsewhere, it's speeded up the whole process, and it's left a whole generation stranded. And we see that, and I'm going to skip ahead here in slides in the interest of time, if I can just get this speeded up here, to this one, which is really showing you what's going on. It's showing that you've had no growth in real, meaning inflation-adjusted wages and household incomes in the U.S. for a decade, and that is throughout the Western world. Nothing surprising about that. Now, that is, interestingly enough, led to a voter revolt. It's not surprising. After all, people haven't had any purchasing power growth, so they got to blame it on somebody. And it's like, anybody remember the old movie Network? Remember the guy Howard Beale there? He's an anchor on a TV station, and he gets out of his chair, he goes to the window, opens it up, and yells out, "I'm mad as hell, I'm not going to take it anymore." Well, that's what voters in Europe and North America are doing right now. They're saying mainstream politicians have not delivered the goods, so who are they turning to? Just run down the list. In France, they have something called the National Front, run by a woman, Marine Le Pen, very far right. In the UK, Jeremy Corbyn, new head of the Labour Party, very much on the left. Germany, Spain, Italy have far right and far left parties. And in Austria, they had presidential preliminary elections, and none of the major parties made it to the runoff. It was the Greens and an extreme anti-immigration policy. Canada, Justin Trudeau, the relatively new prime minister, they're very much to the left, and replaced Stephen Harper, a conservative. And of course, in this country, we've got Bernie Sanders on the left, and we got Trump. I'm not sure how you classify him, but he is very much against immigration. He's very much a protectionist, America first. And the tendency of all these people is to blame the loss of jobs on somebody else. In Europe, they blame it on Syria and Turks taking their jobs. Trump blames it on the Mexicans. And of course, everybody blames it on the Chinese who are manufacturing things much cheaper. And the interesting thing about this is that people, when people have problems, they really get upset. Now, what's been going on in this country ever since the data started in 1966 is that income has been moving percentage-wise. Shares of income have been moving to the top end. The government has statistics by quintiles, and the top 20% has had gaining income shares ever since the data started in 1966, and the other 4 quintiles, shares declining. It's one thing for your share declining, but it's another thing for your purchasing power to decline. And what's happened in the last 10 years, as you show in this slide, is that the purchasing power has been flat, and for most people it's been declining. And that's what really appeals to the political demagogues. So you have this combination, which is really lethal. Now, as I mentioned, you are seeing changes here. Earlier, we had people, in effect, reducing their saving rate, the red line. It started off at 12% in the early 80s. It got down to 2%. And that's what added collectively about 1% to GDP growth. At the same time, people were running up their debt. And you see their debt there, and that's all the consumer debt. That's autos, credit cards, mortgage debt, student loans. Everything is legal in relation to after-tax income. Same denominator as the saving rate. And you can see that the saving rate, it's come back, and we reverse this process, but it's still relatively low by historical standards. And it probably is going to go up because the post-war babies have been very lousy savers. And a lot of people need to save like crazy, or else work until they die, or some of both. And as far as the debt level, you can see there, the norm used to be about 65%. Since the early 80s, it ran up to 130%. It's now down to 105%, but it's got a long way to go until it gets back to norm. And not surprisingly, when you have modest income growth and people saving more out of their income as opposed to spending, you have retail sales have been weak. Retail sales, you can see there, have been declining more months than they've been increasing recently. Now, another interesting phenomenon that's been going on affecting this has been the collapse in commodity prices. If you go back to the end of 2001, China joined the World Trade Center. And many people thought that China was going to buy up all the commodities in the world. And indeed, they were buying over 40% of tin, lead, zinc, copper, other non-ferrous metals, stockpiling oil, coal, buying huge commodities. And commodity producers looked on that and they said, man, we got it made. We're going to invest in all these long-term projects, things like copper, coal mines, iron ore. They take 5 to 10 years to come to fruition in Australia, Brazil, elsewhere. The problem is that by the time those things came to fruition, the demand was simply not there. And this has been a very deflationary force. And the mistake that these commodity producers made is they didn't realize that China was not independently growing. China basically grows through exports. Virtually every developing country grows through exports. None of them have self-sustaining economies. And you look at what's happened to Chinese exports. They used to be growing about 20% annual rate. Now they've been actually declining. Why are they declining? Because where do those exports go? I mean, they're importing the raw materials, they manufacture goods, and then they ship them out to the West, principally North America and Europe. And if you have slow growth in North America and Europe, you simply don't have the demand for those commodities. Now, what China has done to try to alleviate that problem, and this has been touched on by previous speakers, is they basically have built, and Bruce talked about this, they built all these ghost cities and done all this infrastructure spending and done everything they can to keep people to work. And I've said only in half in jest that in China it wouldn't bother them if they had one crew build a steel mill, the next crew tear it down, and the third crew rebuild it. It keeps people employed. And Chinese history is replete with dynasties that have been tossed out because of civil unrest, because of high unemployment. And what I've dubbed the current Mao dynasty, these guys read their history, and they know they have to keep people employed. That's job number one. So they have really been working very hard to do this, but they've ended up with a lot of excess capacity. Another thing that's really affecting China here is that this globalization that I described earlier as the most important of economic development globally in the last 3 decades is basically over. Interesting way of looking at this is U.S. manufacturing as a percentage of total economic activity measured by GDP, gross domestic product. And you notice actually manufacturing started off, you go back to 1899, it was 50% of our GDP. You can see there by the late 90s it was down to 17%. Its decline, it got down to 12% and it's leveled off. And this and other evidence suggests to us that we've pretty much reached the end of the line, that what can be moved abroad has been moved abroad. We got pretty much to an irreducible minimum. Well, that's good news. That's good news for us, but it is obviously mean the end of this growth by absorbing manufacturing activity from elsewhere on the part of the Chinese. And again, this wasn't an expansion of overall demand, it was just where it was done. And China, China's a big country. It's the second largest country in the world. But it's large because it's got a lot of people. It's got 1.3 billion people. Their economic, their GDP per capita is only 1/6 of that of the U.S. They're big because they got a lot of people. They're really an undeveloped country otherwise. Now, of course, with this weak growth, what we've seen universally are devaluations against the dollar. The rationale is very simple. If the economy is growing slowly domestically, in order to juice it, in order to give it some stimulus, the idea is that you export more. And how do you export more? You make your exports cheaper, and you do that by lowering your currency. In other words, if the Chinese yuan is cheaper in terms of dollars, it means that that we pay less for their goods because they're exporting them in their yuan, so they're getting paid in yuan terms, and we're paying them in dollars, and our dollars are worth more. Now, the U.S., I'm not saying that the U.S. is really in great shape, but everybody else is trying to devalue. The commodity currencies, Canadian dollar, New Zealand dollar, Australian dollar, Canadian real, Mexican peso, they all are basically falling with commodity prices. We're looking here at the euro and the yen. They're deliberately devaluing those currencies. And the other Asian currencies are, and the Chinese as well. And, it isn't that we really are doing everything right, but, we're the best horse in the glue factory. A lot of examples of this. We're the tallest midget, the slowest falling rock, the least bad choice, the best of a bad lot, or my favorite is, we're the valedictorian in summer remedial school. Now, if one of the of course interesting commodities that we've all been riveted on is oil. This is the chart that the Saudis love to hate, and this is the one that we've been putting a lot of emphasis on. Actually, over a year ago, early last year, oil prices they had come down from over $100 a barrel, but they were still over $60 a barrel, and I said then that I thought oil prices were going to $10 to $20 a barrel. That got a fair amount of attention. I did a column for Forbes magazine, one for Bloomberg View, where I'm also a columnist, their online thing. And by the way, in our main newsletter, I've written this up. It was a speech I gave in late April to the Japan Society in New York, and I have a few copies here if anybody would like one. But I want to report an experience that Kim can remember of a Money Show a few years ago where I had a few copies of his newsletter, and some people came up, and there was kind of a stampede, and they actually ripped up the last few copies. So I hope everybody here is a little more orderly. And if we run out here, please just let me know. We'll send you a complimentary copy by email. But in any event, what are you basically saying here? What's the rationale for lower oil prices? Because that's a pretty deep development with huge economic consequences. Well, here's where you start. OPEC is a cartel. Cartels are designed for only one purpose, one only, and that's to keep prices above equilibrium. So that encourages cheating. Somebody in or outside the cartel wants more than their share. So the cartel leader's job is to cut its own production to accommodate the cheaters, otherwise the price would decline. And that's what's been happening. You can see the bottom line, OPEC production has been basically flat for 10 years, and all the growth has gone to non-OPEC sources. Who are they? The Russians, the oil sands in Alberta, Canada, and of course the American frackers. Well, what happened was in late November of 2014, the Saudis and their Persian Gulf allies, who also happen to have plenty of foreign currency reserves, so they could lace this out, they said, we're getting tired of this. Because every time we cut our production, somebody else comes in and takes our market share. So we're going to play a game of chicken out there. We're going to see who can last the longest. And the Saudis had close to $800 billion in foreign currency reserves there. Okay, they spent $125 billion so far supporting this, but they're really saying we can last longer than the cheaters. And OPEC production at that point was $30 million million barrels a day. Now it's $33 million a day. Now you say, when you're in this, and by the way, this new crown prince, Prince Mohammed bin Salman, he has really taken over. He threw out the previous oil minister. He just resigned today, I understand, and really said at this Doha meeting, no, we're not going to compromise. We're not going to even freeze production with all the other producers. We ought to see somebody cut. Now, when you're in this game of chicken, what is the chicken out price? Well, it is not the price of meeting budgets. As you can see here, it takes this for the Saudis $96 a barrel. Now we're close to $40 a barrel. No, that doesn't matter because they're saying we got the currency reserves. We can last out, and some of the other weaker OPEC members, well, tough luck for them. The price at which you get chickening out isn't what's called the full cycle price. That's the price of drilling the well, putting in all the infrastructure, the pipelines, the overhead. That's somewhere $40 to $50 a barrel now, and a lot of locations, but that doesn't matter. When you're in a price war, and that's what it is, the chicken out price is the marginal cost. It's the cost of producing the oil. Once the well is drilled, the oil is flowing. It's the point, if you look at it this way, which free cash flow disappears. Think of it this way. If you have an intersection with gas stations on all four corners, and one station starts to cut the price, well, the others have to follow or they're going to lose business, but you can just drive across the street. Where does the price war stops? It stops not at the price of running the station, paying all the overhead, the rent, the staff, and so on. It stops at the marginal cost. It stops at the cost of getting the gasoline off the tank truck, plus, of course, the state taxes. That's where it stops, and that's in a price war. Now, what is that marginal price? Well, in the Permian Basin in Texas, major producing area in this country, it's $10 to $20 a barrel. And in the Middle East, it's even less. So that's where I think the price would stop, and that's what I said over a year ago. Now, of course, many people back last spring, a year ago, said, oh yeah, but these frackers, those wells run out very quickly. They're going to have to cut back. And production has come down. It's come down from 9.7 million barrels a day to 9 million. Not much as much as many people thought, but guess what? They're getting much more efficient. You can see the rig count has come down, the number of active drilling rigs. But they've taken out the old-fashioned rigs, the ones that drill one hole in the ground and that's it. What's left in and what's expanded are the horizontal rigs. They drill down and then they turn the drill bit and they go out like spokes in a wheel. They drill many wells from that same drill rig. And you can see here that the production per well has gone through the roof even though the rig count has declined. So that isn't happening. And on top of that, of course, you have other situations that are and I'll skip over this cartel, we're short of time here, but world oil supply now is running 1 to 2 million barrels a day over demand, and that's at about a 95 million barrel a day total for either one. And Iran has come back on. You know, and they said, hey, we were knocked out when we were under the embargo with a nuclear program. Now we're out of that. We're going to add $1 million a barrel. So the situation really is that oil is in excess supply. Now, what's going to break this situation and drive us to this $10 to $20 barrel number that I forecast? Well, there are two things. One is the financial difficulties. A lot of the oil producers, not the major companies, not the Exxon, Shells of the world, but a lot of these frackers and so on, and other companies and countries, Nigeria, and so on, they are very thinly capitalized. And lower oil prices could really make life very difficult for them. And the other thing that probably may happen in conjunction with it is filling up the oil tanks. Anybody here ever heard of Cushing, Oklahoma? Favorite spot. It's one big tank farm. It's a delivery point for West Texas Intermediate, which is the benchmark crude in the U.S. and other related areas in the world. That's where the price is determined. And this shows the percent of capacity that's filled there. And when that capacity is full, then the oil is basically dumped on the market. And the same is true in Amsterdam, Rotterdam, and Antwerp, which is the delivery point in Europe. You know, if you look at a map, those cities are basically the mouth of the Rhine River. That's where everything comes in and goes up the Rhine into the continent of Europe. And when it's filled up, they dump this oil on the market. So there are two things that I think that I'm watching, and I suggest you watch to see if I'm right on this idea of a further big decline in oil. One is the financial problems, and the banks are more and more being pressed to mark their bad loans to market in the energy area, and the other one is the excess inventories, which I think could really be the death knell of prices. And that could truly give us a global financial problem, depending on how it works out, but it certainly has that potential. Now back to my major point here, though, on deflation, because commodity prices are part of this, and you can see that producer prices, these are prices of goods at the producer level, the wholesale level, and they are basically declining in major countries. They're also declining in China. But the area to watch is what happens at retail, because here you can see U.S., this is personal consumption expenditures. This is everything we all spend on cars, appliances, food, clothing, recreation, travel, medical care, and so on. And you notice there the red line, goods are in deflation. They are actually declining, 1 or 2%, 3% in that area. Services, however, are not yet declining. But that's the spillover is interesting there, because if somebody's laid off from an oil field job, he's not going to spend as much in bars and restaurants and hotels. And so there is a spreading from goods to services in terms of inflation, deflation. And if we see further weakness in services, then I think we do have chronic deflation. This is something that central banks hate. And they hate it because of this very graph here. This shows you what's happened in Japan for the last couple of decades. We've heard about that earlier in this conference. And what it shows is the black line is a year-over-year change in the consumer price index in Japan, and it's been negative more times than not in the last 20 years. Well, what happens is when you have this deflation and it's chronic, people get used to it, and they lapse into deflationary expectations. Now, deflationary expectations I define as a situation where somebody thinks about buying a new car. And he says, well, I'm going to wait because prices are coming down and my old car will run another 6 months. Well, this guy and everybody else decides to wait, so guess what? The inventories pile up on dealers' lots, and they have to reduce prices to get rid of the inventory. 6 months roll by, and this guy and everybody else says, hey, suspicions confirmed. Prices went down. I'm going to wait another 6 months. And the result is less spending, slow growth, and you can see there the blue bars. That's the change in GDP inflation, adjusted for inflation or deflation, more likely deflation in Japan, it's averaged 1.1% growth for 20 years. You think, well, we're at low levels of around 2%. It's been less than that, and for 20 years in Japan. This is what central banks worry about. And that's why every major central bank, the Fed, the Bank of Canada, the Bank of England, the Bank of Japan, the European Central Bank, all of them have a 2% inflation target. They don't love inflation, they hate deflation, they want a cushion. So they actually have an inflation target, but it's because they really worry about deflationary expectations. Now you put all this together, and where do you come out in terms of investment themes and what I think is a very deflationary world? Well, let me say here that we've had considerable success with these themes, but I always remind myself, and I remind you, that markets can remain irrational a lot longer than we can remain solvent. So I'm constantly thinking about that. And by the way, there's also an article in this May Insight talking about not only how you can make money following our themes, or at least I hope you can, but also we list 12 other ways of making big money you might find interesting if you want to read it. But let me just go through these briefly, and I think they follow from what I've said so far. Short commodities. I think commodities are going a lot lower. It isn't so much that demand is falling apart, it's just there's excess supply in the world. We have slow growth and way too much demand of commodities and of all sorts, oil, hard rock, minerals, coal, you name it. The second one, crude oil in particular and related securities. They say if we go to $10 to $20 a barrel, boy, that's a marvelous short, and our portfolios, we are short oil, and that's worked out very well for us so far. Long the dollar against almost everything. Again, I discussed that. That's the safe haven. That's people looking at the dollar as a place to be, and the fact that they're all trying to devalue against the dollar. And they say, why don't we devalue? Well, who do we devalue against? We're the world's currency. There isn't anybody we can devalue against. So the dollar is really the supreme currency, and everybody devaluing against the dollar. Emerging stocks and bonds. These countries grown by exports, and if you don't have the demand from the West for their exports, they simply don't grow. And you've also had a lot of investors in a period of low interest rates who have had what I call zeal for yield, and they've gone into junk bonds, they've gone into emerging market stocks and bonds because they think they're going to get ready returns, and they've been in and out of these, and they, on balance, have not worked out very well, as you know. Long treasuries, I want to come back to that. That's my long-term favorite. Before I do, U.S. stocks. And I do echo some of the points that Bruce made here. Stocks are not cheap. Price-earnings ratios are high. And the earnings to which those PEs are applied are not very sound. Normally, what makes for sound earnings growth is top-line growth, revenue growth. If companies have revenue growth, then they have unit volume, physical volumes of their output are growing, and they have pricing power, the ability to raise prices. Well, the economy's been growing slowly, and unit volume growth has been very low, and with no inflation and deflation at the producer level, there's been no pricing power. So what has happened? As a result, businesses have turned to cost cutting. It's pushed up profit margins. Now, most of those costs ultimately are labor costs, and that's one of the reasons that you have no growth in real wages. But that process worked beautifully coming out of the recession, but it hasn't worked in the last couple of years. Now, I talk to our industrial clients, and I say, what's going on? If you scrape the bottom of the barrel, or if you simply picked all the low-hanging fruit, you have to wait for more to ripen. It isn't clear, but they're not getting that productivity growth anymore, and so we're not getting this margin improvement, and that's really what's been pushing stocks. So I think stocks are vulnerable. It doesn't say the economy's collapsing. It just says the sources of growth aren't there. But finally, let me turn to these treasuries. As some of you know, I've been a fan of treasuries, long treasuries, since 1981. The yield on the 30-year bond at that point was 15.21%. It's now 2.7%. And some of you heard me say this many times in the past. I've never bought treasuries for yield. I couldn't care less what the yield is as long as it's going down. I buy for the same reason most people buy stocks, appreciation. Now here shows you an example of the power of this. We're using 25-year data. because of availability. I prefer the 30-year bond because the longer the more maturity, the more bang per buck you get as interest rates go down, the price goes up. Unfortunately, it works the other way. If rates go up, the more money you lose. But this shows the example. If you bought a 25-year zero coupon Treasury, you know, they come at a discount, they don't pay interest, but they mature at par. I can go into that, anybody who wants to know the details. But if you bought that in October of 1981 at the low in price, the high in yield, you roll it over each year to maintain maturity, your $100 then is now worth $28,666. In contrast, if you bought the S&P 500 at its low in July of 1982, and you reinvested the dividends, total return, your $100 would be worth $4,527. The bonds, the Treasuries, have outperformed stocks by 6.5 times, 6.5 times. And of course, I assure you that long Treasuries are only suitable for little old ladies and orphans. You're far too young, Tim. In any event, now, where do you go from here? I happen to think that we're not through with what, back in 1981, I dubbed the bond rally of a lifetime. I think we're going to 2% on the 30-year, and on the 10-year, we're going from about 1.7% to 1%. If we go from 2.7 to 2%, and you buy a 30-year coupon, zero coupon bond, you'll make about 25% on your money. So what I call the bond rally of a lifetime is not over. In any event, these are the implications of our view. It's a deflationary world for my money, and I think there are ways you can make money in it. And I hope you have good luck trying. We certainly have done so well so far. Thank you.